The financial industry is going through, well, probably its biggest architectural shift since we all started banking online, 20 years ago?
Absolutely. We've heard so much talk, so many promises about blockchain for years.
Right. Potential.
Exactly. But the sources we've been looking at for this deep dive, they suggest we're really past the potential stage now. It feels almost inevitable.
Inevitable how? What are we actually talking about here?
We're talking about a complete redesign of commercial money, specifically institutional stablecoins.
Okay, institutional stablecoins. Break that down.
Well, the premise laid out in these sources is pretty stark, really. It's that every major financial player, think banks, credit unions, big global fintechs, they're all heading towards issuing their own branded, regulated, dollar-backed stablecoin.
Their own branded coin.
Yeah, that's the next phase.
Wow. Okay, that sounds huge. And honestly, maybe a bit chaotic. If everyone's got their own digital dollar.
It could be, yes. But what supposedly makes this not just possible, but, as you said, inevitable, is the underlying infrastructure.
Ah, okay. The plumbing underneath it all.
Precisely. And that's what we're digging into today. The Metallicus digital banking network, they call it TDBN. It's anchored on something called the Metal blockchain.
TDBN, Metal blockchain. Got it. So our mission today is basically to unpack all this, right? Figure out the who, what, how, without getting lost in the jargon.
That's the plan. Give you a clear picture of this new financial architecture that's emerging.
Okay, let's unpack this then. Where do we start?
Well, to really get the significance of TDBN, you kind of have to look at it like a banker would strategically. Think about how banks built their identity historically.
Physical branches, right. Their own online portals, the logo on my credit card.
Exactly. The brand was tied to those physical or proprietary access points, your Visa, your MasterCard logo.
Yeah.
The vision we're seeing in these sources is that institutional stablecoins are going to take over that role. The stablecoin itself becomes the brand.
The coin is the brand.
Interesting.
It's the core digital identity of the money, carrying the promise, the backing of whoever issued it.
So who's actually doing this now? The sources mentioned specific examples, didn't they? This isn't just theory.
No, not just theory. The most interesting first movers mentioned are actually U.S. credit unions.
Credit unions, really? Why them?
Well, they're looking at issuing member-only tokens. Think about it. You could create these localized spending tools, money designed to be used within a specific community of members.
Like keeping money local.
Sort of, yeah. And it also helps them streamline services between different credit unions. If you move your account, maybe the value moves instantly using these tokens, bypassing the old clearing systems.
Okay, that's clever for credit unions. What about the big banks, the traditional players? What's their angle?
For the big banks, it seems to be much more about corporate efficiency, at least initially. They're looking at regulated tokens for critical business functions.
Like what? Think about the headaches in corporate treasury today. Getting instantaneous, secure settlement for large trades. Automating payroll, especially across different countries. Managing treasury in real time.
Stuff that takes days right now.
Exactly. A bank-issued dollar-backed token could, in theory, make all that instant, 24/7.
Okay. And fintechs, they're usually faster movers anyway. How do they fit in?
For them, it's really about global reach and new markets. Using compliant stablecoins lets them do cross-border remittances instantly. Forget wire fees and delays.
Right, just send the value token to token.
Precisely. And it also opens the door for them to create new global lending markets more easily because settlement isn't tied to specific geographic rails anymore.
Okay, this all sounds very efficient, but I have to push back a bit here. If every single institution issues its own coin, bank A coin, credit union B coin, fintech C coin, aren't we just creating hundreds of new digital silos?
That is the million-dollar question, isn't it?
Yeah, it feels like swapping old problems for new ones.
And that's exactly what the TDBN architecture is designed to prevent. This is supposedly the key differentiator. These institutional tokens, they aren't meant to be siloed.
Okay, how?
They're engineered from the ground up to be networked through this metal blockchain. The design specifically aims to let value move instantly and, crucially, compliantly between any institution on the network. Doesn't matter who issued the coin.
Ah, so the value isn't trapped within one bank's coin. It can move across the network.
That's the core idea. The network layer connects them all.
Okay, so the magic is in the network connecting these coins, not just the coins themselves. That makes sense. Which brings us to the architecture, right? The layers, you mentioned layer 0, layer 1, and these subnets.
Exactly. Let's use an analogy. Imagine building a huge interconnected financial city. The metal blockchain, that's your secure layer 0.
Ground level, the bedrock.
Kind of, yeah. It's the foundational security, the property lines, making sure ownership and contracts are locked in, immutable.
Okay, secure foundation. Then layer 1.
The XPR network, that's the layer 1 settlement hub. If layer 0 is the bedrock, layer 1 is like the super fast highway system built on top.
Handling all the traffic.
Right. Setting the rules of the road, ensuring rapid transit of value, connecting all the different districts, the institutions within this financial city.
Okay, bedrock highway system. Now, subnets. This is where the sources said it gets really interesting for regulated finance. Private chains with public reach. That sounds like what banks want, doesn't it? Control and connection.
That's precisely the appeal. See, when a big bank or a large credit union joins the TDBN, they don't just throw all their sensitive customer data onto one big public chain. That would never fly.
No way.
Instead, they spin up their own private subnet, running on the Metal blockchain infrastructure. This gives them essentially institutional sovereignty.
Sovereignty, what does it actually let them do?
Well, it means they keep total control over their own environment. They get to define their own transaction rules, their governance, the specific digital ID checks required by their regulator.
So they tailor it to their exact needs and compliance rules.
Exactly. They can set fees, specific parameters for their customers, all without needing permission from the entire network. And crucially, it gives them scalability. They can handle millions of their own customer transactions daily without slowing down the main network.
So they get the privacy, the custom compliance, the scale.
Yes, the private chain part. But, and this is the clever bit, these private subnets are designed to seamlessly connect back to that layer 1 highway, the XPR Network hub.
The public reach part.
That's it. So even though they have their private space, they instantly benefit from the liquidity and the ability to transact with everyone else on the broader digital banking network.
Okay, so it's like having your own secure corporate campus, but with direct high-speed access ramps onto the global interstate system.
That's a great way to put it. It blends the control of private infrastructure with the network effects of public connectivity. It tries to solve that core tension for regulated finance wanting to use blockchain.
That really does sound like it tackles a major hurdle, because just being fast isn't enough, is it?
Not even close. Speed is useless without trust, especially in finance. Stablecoin adoption, particularly by institutions, demands a compliance-first approach. It has to be built for them, separating it completely from, the speculative, permissionless DeFi world.
Right. So let's drill down on that. How exactly is trust and compliance built into this TDBN protocol?
Yeah.
What are the mechanisms?
There are a couple of key things highlighted. First, something called decentralized identity, or DD.
Okay. DD, what's that do?
Basically, every user, every institution, and this is important, every single transaction gets cryptographically attested using these secure identity protocols.
So you know who's doing what, essentially?
In a compliant way, yes. It ensures full KYC. Now your customer and AML anti-money laundering rules are enforced right at the protocol level. You simply can't transact on TDBN without having a verifiable, compliant identity attached. It protects the network's integrity.
Which is absolutely non-negotiable for any regulated bank or credit union. Okay, identity is covered. But banks also need to talk to each other, right? They have these ancient messaging systems.
Well, maybe not ancient, but complex. And that's where the second mechanism comes in. ISO 2022 messaging.
ISO 2022, I've heard of that. That's the new global standard for financial messages, replacing things like old Swift formats.
Exactly. It's the modern common language. And the stablecoins on TDBN are designed to integrate directly with this standard.
Why does that matter for, say, a bank treasurer? Is it just making the crypto transaction look familiar?
It's much more than just looking familiar. It's about compatibility. It means these digital assets can communicate smoothly with all the existing financial plumbing, clearinghouses, core banking systems, payment processors, even the regulator systems.
Ah, so it reduces the integration headache. They don't need to build complex new bridges.
That's the idea.
Yep.
It dramatically lowers the barrier to adoption because it speaks the language the rest of the financial world is moving towards anyway.
And the sources mentioned regulatory alignment, too. They're building this with current regulations in mind.
Very much so. They specifically cite things like OCC interpretive letters, the Genius Act proposal, alignment with frameworks like FedNow and CUA guidance. The goal seems to be ensuring institutions using TDBN are compliant right out of the gate, building the road with the regulatory lane already paved, so to speak.
Okay, so we have compliant private chains, the subnets talking a common language, ISO 2022. Let's circle back to that XPR Network Layer 1 hub. You said is the engine linking everything.
Right. What's really fascinating is how this Layer 1 hub acts as the liquidity engine. It's positioned as the central hub for this whole new financial internet, its main job, making sure every institution's coin can instantly trade or settle with any other institution's coin on the network.
How does it do that, though? Bridge all these different branded compliant tokens? Why not just use something like, say, USDC that already exists?
Good question. The key piece here seems to be something called the Metal Dollar, or SexMD.
Metal Dollar XMD.
It's described as a bank-ready stablecoin, built specifically to be the reserve and bridge currency connecting these regulated institutional tokens within the TDBN ecosystem.
So why not USDC?
Well, the argument is that SexMD is designed from the ground up within TDBN, ensuring it meets the specific compliance and identity rules enforced by the platform itself. It's native to the system's requirements.
Okay, so if my credit union's token needs to settle instantly with a big bank's corporate token, they don't trade directly, they use XMD as the bridge in between.
That's exactly the mechanism. It acts like the neutral settlement layer, the oil in the machine, ensuring there's always instant liquidity and finality between any 2 points on the network.
Think about the friction that removes.
Mm-hmm.
Paying someone overseas now can take days, multiple banks, fees.
Right. With this model using SexMD on the TDBN, that payment could be theoretically instantaneous, final, and fully compliant and transparent in seconds.
Okay, so it links all the internal institutional tokens.
Mm-hmm.
Does the XPR hub also connect outwards to the wider crypto world?
Absolutely. That's highlighted as a key feature. Institutions using TDBN can offer their customers ways to transact smoothly with what they call blue chip crypto assets, Bitcoin, Ethereum, existing stablecoins like USDC.
So banks can finally bridge the gap between traditional finance and digital assets for their customers.
That seems to be a major value proposition, yes. expanding their service offerings significantly.
And you mentioned programmability earlier, too.
Yes, the hub itself is programmable. This allows for more advanced services, things like instant compliant token swaps, decentralized lending, they mention a specific loan protocol, and setting up complex, automated, programmable payments.
And all within that regulated, compliant wrapper.
Exactly. Everything operates inside the required institutional environment.
Okay, this brings us nicely to the final section, connecting all this tech back to real-world use and the user experience.
Huh?
You mentioned credit unions are early adopters. Where do the sources see this going in terms of scale?
The trajectory described as well, it's exponential. The expectation is Tier 1 banks adopt subnets for things like global corporate settlement, totally overhauling their treasury operations.
Oh.
Fintech giants embed these stablecoins directly into their mobile apps for payments and remittances.
Makes sense.
And maybe the biggest one, the sources anticipate governments potentially deploying their sovereign digital currencies, CBDCs, directly onto the TDBN platform, leveraging its built-in compliance and interoperability.
Wow, CBDCs on this network. Okay, so the big conclusion the sources seem to draw from all this, it's pretty profound. Banking is needed, but not the banks.
That phrase really captures the potential shift, doesn't it? The core services we get from banks, payments, lending, saving officials, they don't necessarily need the traditional bank building or structure anymore.
They can be delivered directly through these networks.
More efficiently, potentially. These interconnected, compliant blockchain networks could handle those functions directly. The need for some of the slow, expensive intermediary steps starts to fade when the rails themselves are instant, trusted, and transparent.
And for the actual user, the access point changes completely. It's not the branch, not even the bank's own siloed app anymore. It becomes the wallet.
The wallet is the new bank branch. That's the idea.
How so?
Well, platforms like WebAuth.com, which the sources mention, are examples of this. A single digital wallet could let you hold, manage, and transact stablecoins issued by any institution on the TDBN network.
So in one app, I could have my credit union's member token, maybe some of a big bank's settlement coin, if I'm a business user.
Exactly. And that wallet can handle the different compliance rules attached to each one seamlessly.
And it's not just for holding the coins, right?
No, it's the portal. It lets you access compliant DeFi services, maybe staking, earning yield, participating in lending protocols like the loan one mentioned, all alongside interacting with your traditional bank accounts or even blue chip crypto like Bitcoin.
So the power of this whole interconnected system fits into one interface in your hand.
That's the vision. Consolidating financial access.
The application seems pretty clear then. It collapses a lot of old infrastructure, puts more utility directly with the user, and potentially solves decades of friction, especially in global finance.
It aims to build a system where efficiency isn't a premium add-on, it's just the default way things work.
Okay, so let's try and synthesize this. The TDBN blueprint we've discussed. Every institution issues its own stablecoin. These live on secure, private subnets that handle compliance. But they're all interconnected and made liquid through the XPR settlement hub using things like SexMD.
Right, which means money becomes programmable, payments are instant, and that critical regulatory trust is sort of baked into the protocol itself.
It sounds like the infrastructure designed to finally let the big regulated players comfortably enter the digital asset economy.
Without sacrificing security or regulatory standing, yes, that seems to be the core objective.
Okay, so here's the final thought, the one for you, our listeners, to mull over. If institutional trust, the trust we use to place in the physical branch or the bank-specific online system, if that trust migrates to the utility and the seamless interoperability offered by a single digital wallet, what happens to brand loyalty? When you can access every financial service you need, regardless of who issued the underlying token, all through one universal interface.
What does loyalty mean in that world? Something to think about.
Definitely something to consider as this massive transformation keeps unfolding.